Thank you very much for joining us again for the third session. And I'm very happy to have as chair Paul Thanos, a seasoned executive at U.S. Commerce, who has assembled an outstanding group of experts and professionals. And Paul, going back to you.
Thank you, George. And let me just say first, it's a real pleasure to be here this afternoon. And again, I'm Paul Thanos with the Commerce Department's International Trade Administration. And for those of you who may or may not be aware, International Trade Administration, or ITA for short, is about a 2,000 person global network. Our mission is essentially to support the global competitiveness of U.S. industry, and we do that through trade policy, trade promotion, analysis, and a variety of other tools. What we've assembled here this afternoon is really an all-star panel of representatives from the financial services industry and also the leading trade association representing the services industries writ large to highlight opportunities and challenges in global markets for financial services, and also some of the key issues that are important to the industry and international trade. And this panel is going to be organized somewhat as a conversation, and we're going to start by asking a broad question that will allow all the panelists to introduce themselves and their companies or associations. And so let me start by asking this question: and why is trade important to you? And I'll turn to Chris to begin.
Thank you, Paul. So I'm Chris Melly with AIG. I joined AIG about a year ago, coming from the Office of the United States Trade Representative, where I worked on services and investment issues for a number of years. So AIG, why, and looking at the insurance business, why does trade matter to us? I think I could see it in two dimensions, really. First would be the clients, and the second is AIG as an actor in international markets itself. On the client side, think about all the different links in trade. You have a producer. You have a trucking company that brings the production to a port. You have the port that loads the production on a ship. You have the ship and its cargo. Each of those legs is insured. So as trade products move through the production cycle to shipping and then to the ultimate destination, every link in that chain has an insurance component. So the trade volume and the growth in trade volume creates opportunities for the insurance business. That's why the trade is important from the client perspective and is a major source of business for insurance. For AIG, we're a global company. We were established in 1919 by an American in Shanghai. Today we operate in 80 different markets, and we have partnership arrangements that bring us to about 215 different markets. So we are active participants as a service supplier in providing services on a cross-border basis when we insure a ship, but also when we provide, say, property insurance within a particular market, whether it's Vietnam, China, Europe, or whatever. And so the terms and conditions of trade are important to us, both for how our clients interact in their prosperity, as well as how we run our business and the opportunities that we have in various markets around the world.
Well, first of all, I really want to thank Drexel University, the LeBeau School College of Business, Global Interdependence Center, and to our good colleague Paul for the opportunity to be part of the panel today and the very distinguished program that's been assembled. So from my perspective, I, like Chris, as a former government trade negotiator, I left the government about 3.5 years ago. And I represent the Coalition of Services Industries, which is an association that's been around for the last about 3 decades. And it represents U.S. services companies with respect to services, trade, and investment issues. And so my members really run the spectrum from ICT services to logistics to media and entertainment to financial services, as you see here, professional services. So it's a very cross-section of the services sector. And one of our big challenges in our mission is to do a lot of educating about the importance of services generally in the market and globally, as well as on the trade agenda. And so one phrase we like to use is that you cannot make it, move it, buy it, or sell it without services, to try and make it real to people. Because 8 out of 10 of us are service suppliers. 80% of US GDP is the result of economic activity related to services. And over the years, what's happened on the trade agenda is there's been a shift from more traditional kinds of trade barriers that, in Chris's introduction, alluding to why trade is important to AIG, whereas traditional market access barriers like investment limits on foreign investment or the barriers to the ability to supply your service on a cross-border basis that we really fought and created rules and trade agreements about, those have evolved. So yes, we continue to deal with those kinds of issues, but there's also a whole new layer, and that is the digital trade revolution that's occurred and how that's affected services. So you really have these 2 currents that we now face, both on the traditional side and on the digital side. And why is trade so fundamentally important, going back to underscore the points that Chris was making for AIG, across the board for services suppliers, 95% of consumers are outside the United States and 80% of global consumption purchasing power is outside the United States. So trade is a no-brainer. It's a must-have if services is supposed to expand. And why specifically is trade so important? And we make this point so often to the administration and to the Hill. 39 million US jobs are tied to trade, and roughly 36 million of those jobs are services jobs. So there's a very clear black and white explanation why trade and investment are so important in the services industry. 2 last key points. One is that there's untapped potential in the services sector, even though it's so hugely important. 2, investment is absolutely key to service sector growth and jobs because of the heavy regulation that many services sectors undergo. You're going to hear about that from Yancy and others with respect to prudential regulation in the financial services sector. So there's just not a question of if you want to get in the market, you have to invest. So that's very important. And then last but not least, because services has done so relatively well in global markets, it's the source of a trade surplus for the United States, which is extremely important and unfortunately very overlooked. So let me stop there. Paul.
Thank you. Yancy.
Thanks, Paul. My name is Yancy Molnar, and I head up international government affairs for Chubb. And Chubb is the largest publicly traded property casualty insurance company in the world, and we're the largest commercial insurer in the United States. So I don't want to trip over Chris because we're very similar, so all those reasons he outlined in terms of why trade is important to us, very similar in our case. I'll just add a couple points beyond the fact that having more trains, planes, ships, cargoes moving back and forth is good for our industry. The other important part is that where the growth is. So the insurance sector has been around for a long time, and it's mature in the developed world. So growth rates in Europe or the United States are really at single digits, if at all. But growth in Asia and in Latin America is, in many cases, double digits. In Asia in particular, you have this huge emerging middle class. That's when people start buying cars and houses and starting businesses, and all those things need to be insured. And having access to those markets is critical for the long-term success of our companies. So just add that. As Chris said, we insure everything from the largest multinationals to the smallest mom and pop shops. All of those, and in between, need access to international markets. Our ability to insure them plays an important role to that. And then we'll get into what some of the impediments are, so I'll leave it there. One other thing, just with my background, just so you know, all these guys have been trade negotiators. I'm the one that has not been a formal U.S. government trade negotiator. But in my previous life, I've been with Chubb for 10 years. Prior to that, I was in the auto industry for 10 years, working with Chrysler, and I spent 3 years in China. So I don't know if these guys have been in China, but at least I've got something to bring to the table.
Well, something we can probably all say is that we all worked on the WTO China negotiations, so we have some links to China. Good afternoon, my name is Kimberley Claman, another recovering USTR negotiator working on the same team with Chris and Christy. I am the Citi's trade and investment expert, working on policy matters around the globe. I'm sure you're all familiar with Citi and its size, but just a few factoids to put it in this context of trade agreements. So Citi's been around about 200 years, and we're a very different company than, we've been evolving as time has been passing and global trade has been growing. And so today we're focused on serving our target clients in two core areas: institutional clients group and global consumer bank. Our global consumer bank operates three businesses: the largest global credit card issuer, a retail bank with an urban footprint, and a commercial business serving mid-sized clients and with cross-border needs. And we serve consumers across the full spectrum for their financial needs in 19 markets. And we're significantly accelerating our speed to market with new digital products, features, and capabilities by deploying new technology and using an agile operating methodology. I point out particularly this point about the largest global credit card issuer and this rapid deployment of new technology, because I think, as you'll hear throughout this program, as Christy mentioned, digital trade is becoming more and more important for the financial sector. I think you've probably heard our CEO say we're actually a technology company with a banking license. Our institutional client group is scaled to serve multinational companies, emerging market leaders, governments, and investors through our unique global network across more than 160 countries. That network facilitates an average of $4 trillion of flows daily. And again, we are relying on the global network and an industry-leading technology platform to allow our clients to transact anywhere, anytime with seamless connectivity. So linking this to trade agreements, why are they important to us? You might think, oh, well, you're in 160 countries. Trade agreements with traditional issues like being able to invest in that market, are those still problems for you as Citi? Well, here's the fact. We're in those markets, but these trade agreements, they do continue to help Citi because we are looking at new issues that we are facing, particularly in this digital area. And second, we look at trade agreements not through the lens of what's good for Citi, but we look at it through what is good for our clients. So if you think about a multinational client who's seeking to invest in that foreign market, that market being open for investment means that Citi in the future can provide them more services. So I think probably many of us don't look just at trade through what is in our own interest, but what is in the broader interest of the services that we can provide to our clients and customers.
Thank you. So Kimberly alluded a bit to trade agreements, and I wanted to tease that out a little bit and turn to Christy and ask her, given her perspective, why are trade agreements important to you, your members?
Thanks, Paul. Well, I think some very obvious points, and that is that in a commercial sense, trade agreements really create rules of the road. Given each economy, there are, of course, regulatory rules of the road and laws that you must follow in operating your business. But trade agreements cross borders and create obligations between parties that also create another source of rules for the road that create commercial certainty, create stability, and importantly, they're binding, so that companies, individuals know that if a country acts in violation of that trade agreement, it can go and seek redress. So I think fundamentally, that's why trade agreements are so important. In terms of what they actually do, they create rules with regard to non-discrimination, which is critically important. They create rules that require governments don't arbitrarily limit the number of service suppliers. They create requirements for transparency, which is critically important. And they also create obligations with respect to investment. And Yancy talked about that a bit, and I think gave some very specific ways in which for insurance, for example, and Kimberley also alluded to that, is so very important, particularly for services, because if you look at total U.S. global investment, you will find that services makes up the lion's share of that global U.S. investment. So it's critically important that these trade agreements also have rules of the road on investment and the ability for individual investors to seek redress for those rules when they're violated. The other thing that is common in trade agreements is a dispute settlement mechanism, which again is very, very important because this is ultimately what makes these rules binding. The other thing and general point I would say is while the U.S. does have some 20 FTAs in effect, obviously USMCA, the most recent, potentially something, an agreement with Japan, the EU, maybe way down the road the UK, but we need to really be looking over our shoulder because if you look at what the EU is doing, it already has 9 FTAs in place, but 25 FTAs that have actually been signed and are on the verge of being implemented, and another 19 ongoing negotiations. So that's a pretty impressive long list of countries where the EU is out there shoring up its tie, creating preferences where the U.S. is just not active or a player. Japan has 18 FTAs in place and 5 in negotiation. So the U.S. needs to really be thinking about, are we doing enough in the international stage? And the last thing, to Kimberly's point, it's very important that trade agreements be adaptable. And that's where over time, in our experience as negotiators, but also in the private sector, I think we've been involved in that effort to try and make them adaptable. And probably the 2 most obvious areas where that's happened is one in digital trade, both with respect to financial services, where there was a major achievement in the USMCA with respect to data localization disciplines, and the digital trade chapter, and then secondly, in the area of state-owned entities. So let me stop there, but just, I think adaptability and dealing with things as they evolve, as technology evolves, is very important as well.
So you've heard a little bit about trade and trade agreements, and I want to pivot now to ask the panelists to address what sort of trade problems would they like to see resolved? Where are sort of some of the challenges? So let me start with Yancy.
So Christy has been highlighting the importance of investment for the financial services sector in particular. And throughout this conference, I think President Harper mentioned it and others have mentioned it. What businesses are seeking is certainty. And that's really what trade agreements provide, sort of a floor of certainty to allow you to operate your business. For us as an insurer, being able to invest in markets is critical. As an insurance company, we're not selling product, we are selling a promise, right? So it's a contract The policy is a contract, which lays out terms, which, we will pay if there is a claim. So the rule of law is critical to the insurance sector, and trade agreements provide some of that stability and legal framework. We are a heavily regulated industry, not just insurance, but also banking. And the ability for us to engage in cross-border insurance is actually fairly limited to products like aviation insurance, marine, cargo, very trade-specific insurance. Those types of things you could do on a cross-border basis, meaning if I have my office here in Philadelphia, we could sell those products from here. But the bulk of our business has to be done from within the country because of prudential regulatory requirements. In order to sell primary commercial insurance to a Spanish company, you have to be in Spain. Or if you're selling life insurance in Argentina, you have to be in Argentina, not because you want to be or you need to be close to the client, although that's important, but you're required to for regulatory reasons, for prudential reasons. As insurers, we have to have capital in those countries. We're required to establish in those countries. We have to either have a branch or a subsidiary. And so, trade agreements help, they help define and protect us in a number of ways, and I'll talk about investment in particular, and protecting those investments, because we don't have a choice. If we want to do business in these international markets, we have to invest in them. So we rely on these trade agreements to provide us some protections. We recognize we're a guest in these countries in which we operate, but sometimes we'll enter a market because the conditions seem right. There's a need for insurance, and then conditions change. You can have governments that change, and governments can require certain conditions. For example, something we face, particularly in Asia, is limits on our investment by the imposition of foreign equity caps. So we can only own so much of a company. We have to find a local partner, and we're not entirely opposed to that because sometimes it makes sense to find a partner. But if you're forced to find a partner, that can create problems because sometimes you just can't find the right partner. They may be capital constrained. They're not interested in growing the business. They may just want to just take their profits and not put in any more capital. Whereas we tend to like to grow our business when we enter a market, and we're therefore limited by having such a partner. So what do trade agreements do? In many cases, U.S. trade agreements, which we consider gold standard agreements, would prohibit those type of investment restrictions. And the other important thing that these trade agreements do is provide an enforcement mechanism. And you hear a lot of this discussion right now related to USMCA and the updated NAFTA, that it's really not about the provisions of the agreement, it's the ability to enforce and implement the agreements. So these protections are critical to us in the financial services sector. The way that you get enforcement is through investor-state dispute settlement mechanisms or state-to-state investment mechanisms. And frankly, for us, and others may have different opinions, the biggest benefits of these enforcement mechanisms is the deterrent. Because if the country understands that they have this trade agreement with the United States and they have these investor protections in place, you'll prevent them from putting them in place in the first place. So I'll stop there. Yeah.
Thank you, Yancy. Kimberley?
Thank you, and we support all the comments that Yancy said. I would just add that, a lot of criticism we hear about investor-state arbitration, if you're reading about that, is that, it implies that companies rely on that kind of mechanism in a whimsical way, and that's just simply not the case. Obviously, as investors and guests, as Yancy said, in the country and highly regulated companies, we wouldn't take lightly pursuing that kind of enforcement mechanism. The issue that we find that we are facing in many markets is in the digital space, which is why I alluded to that in some of my opening remarks. And as Christy noted, in USMCA, there is the gold star standard for digital provisions. And this has not been the case, for example, in TPP for financial institutions. So as we've evolved in globalization and a digital world, global data flows are essential for companies of all sectors to create innovative products, provide services, enhance productivity, compete in foreign markets, combat fraud, and create jobs. And if you think about it, this concern on the free flow of data and ensuring that companies have the choice of where they want to store their data, it's counterintuitive, actually, if you think it through, the restriction on data flows, given that interconnected global trade relationship. And so for the financial industry, transferring data across borders is crucial because it allows us to provide core products and services to the customer, manage risk on a holistic basis across affiliates and borders, and to comply with financial regulatory requirements in various jurisdictions like Know Your Customer and anti-money laundering regulations. And USMCA is the first agreement that we were able to secure that free flow of data and prohibition on data localization commitment. And it actually took a fair amount of education, both internally, I think, in all of our companies, but also externally with our US regulators, to get them on board, that they too should support these types of provisions in trade agreements. Now, imagine if we are trying to convince our foreign regulators of that same idea, right? Because financial regulators are not technology experts. And so when they are thinking they either are looking to enhance cybersecurity or ensure privacy, they think, well, if I have all the data in my market, that's how I'm going to do it. That's how I'm going to make it work. When the reality is that it actually creates more cybersecurity risks to have to open and put up data centers in each of the countries that we operate in, because in doing so, you're creating additional entry points into the platform, into the system. And it's not making the data, it's not creating that privacy that you would, that some regulators like to think about. It's actually the tools, it's the way you store data and those cybersecurity tools that you use that ensure the privacy, and you limit who has access to the data. So it's not about where it's stored, it's about ensuring that only those that need to have the access to the data receive the access to the data. And just to point out that regulators need access to data. So one of the innovative points in the USMCA text is that the provisions say ensure the free flow of data, and it prohibits data localization policies. But it also recognizes that we as financial institutions have to provide certain data to our regulators so that they can do their supervisory and regulatory role. And we're comfortable with that. It's a system we're used to operating in because we are that highly regulated sector. The other issue that I wanted to mention, which also appears in USMCA, and it appears in the digital trade chapter, whereas these other two commitments I've been talking about specific to financial services appears in the financial services chapter, is prohibiting the transfer of technologies, and such as source code and algorithms. Now you might think that only would be important to tech companies, but that's actually not true, because we are innovators as well, and we have source codes and algorithms that we utilize in securities markets and trading platforms and those sorts of things. So not having to provide that to a state actor or transfer it to a state-owned company is important to us as well. And so those are the kinds of provisions that we would like to see going forward in trade agreements and ensure that they apply to all sectors, including financial services.
Thank you, Kimberly. Chris, problem you'd like to see resolved?
Thank you. Actually, I also want to pick up a bit more on the digital aspect and just with some kind of examples. I mean, on the algorithm side, I was just reading about a guy in our research division who developed an application for using your phone to take pictures of your car accident and develop an estimate of what the cost would be based on the visual imagery provided. He got a patent on it, and so I mean, it's in the intellectual property business. But from a practical perspective, how would a company deploy something, technology like that? I mean, you want to use the cloud, right? You have that house somewhere where you're continuously updating it using artificial intelligence to improve it, and then disseminate that and apply that technology wherever you can. But if you're required to break up your data into fragments and to separate your servers into individual markets, that really limits the ability for you to deploy a technology solution like that. So that's a big factor of why this digital trade is important to us. Another aspect of it is compliance. I mean, so every country has their own regime on privacy, on cybersecurity. Imagine trying to keep track of that and to comply, and sometimes one country may not agree with another country, even within the EU. Their policies at times conflict, and it may be impossible to meet both standards. So the benefit of having all of this technology is that it's running us up into government policies that at times contradict, and this is really an important area for trade policymakers to look into. The other point was I wanted to raise a bit more insurance specific, but also ties into this concept of localization. And that's what a challenge we have called reinsurance localization. Reinsurance is basically the resale of insurance policies to some insurance risk to another company that can better manage that risk. And there are lots of reasons why companies would want to do that. Some countries, however, have imposed a requirement that if you want to reinsure outside of that country to the global market, that you have to reserve, say, 20% of those contracts to a local supplier or a class of local suppliers. From a trade perspective, that's basically handing a portion of a market to a local to local production, which would be inconsistent with the national treatment concept. From the company perspective, because it means you've got to do business with somebody you may not choose to do business with, and it limits your flexibility. And from a market risk perspective, it also means you're concentrating risk within that market rather than enabling the insurers to place the risk on the global markets, which are more liquid. So that's an issue, insurance specific, that are working hard on to try to address through education and to the extent possible trade agreements and negotiations.
Well, thank you. Just a couple things to add. One, just on the excellent insurance examples that have been provided, particularly what Chris was just highlighting, is I think underscores another major problem, and it's not just in the insurance sector but generally, and that is that in the instance of mandatory sessions for reinsurance, it can also highlight the lack of expertise in a particular type of insurance in the local market, which again can be less efficient, harmful to the domestic consumers. I remember this came up, for example, in TPP, when we were dealing with officer and director liability insurance in particular, and there simply was not the real domestic capacity to offer that. So anyway, just another point, there can be real lack of expertise that also creates a barrier. The second thing I was going to say that I think the illustrations that have been given are really important, and I know I preach a lot about this, is that when you tackle these trade problems in the services sense, there really are two levels that you have to look at. You have to look at what is the country in which you're operating and basic commitment with respect to the service that's being provided. So in the case of insurance, what type of insurance, what are their commitments with respect to cross-border or typically an investment sense. And then on top of that, now we have the overlay of the digital rules that are critically important and how they interplay with those underlying service commitments. The one other example that I wanted to mention in the financial services sector that's very important and has become increasingly important is electronic payment services. And here you might associate this more typically with the credit card companies like American Express, Visa, or MasterCard. But actually there are numerous US service suppliers and non-service suppliers that are getting into this business as well. And so this is another area where the kinds of data localization barriers that Kimberley in particular was outlining, and Chris to some degree, can really prevent those kinds of companies providing their services, because typically what the US EPS suppliers will do is they will supply on a cross-border basis from servers that operate in the United States or perhaps on a regional basis that have highly sophisticated security, software, services where they can guarantee the protection of the data that they're processing. So if they're required to establish locally, one, they incur considerable expense, and two, it may be more difficult for them to employ the same kind of security system that they have operating in their home country markets. And then lastly, another form of this is, unfortunately, particularly in ASEAN countries are beginning to set up what are called national payment gateways, which means that if you want to provide any kind of electronic payment processing service, you have to use the local gateway, which makes it impossible for you to use your own domestic software security system, which makes the whole delivery of the service far less reliable.
So everyone has heard so far, from our panelists, how highly regulated financial services is. And, I would ask Yancy to elaborate a little bit, working for, in this case, insurance, what is the nexus between regulation and trade? And is there a gray area between when something's a regulatory issue and when something might be a trade issue?
And I think we talked about some of the examples and some of the tensions that you've been hearing from us in terms of operating in these local markets. I think it's important to note, so we've stated that we're heavily regulated, we don't have much of a choice, we have to be in the markets in which we operate. And I think it's important to distinguish between financial regulators around the world. So if you think of US regulators or financial regulators in the European Union or Japan, advanced markets, they're primarily tasked with protecting the consumer and maintaining financial stability. However, in some developing countries, these regulators have a dual task. One is that of protecting the consumer, but they are also tasked with developing the local industry. So this is complicated for them because sometimes those two goals contradict each other. You may be trying to build your local industry, but some of your companies are so small and really insolvent and actually put your market at risk. So again, trade agreements help in these instances by trying to take that and address those discriminatory policies that regulators may impose. The other important issue is the fact that in the financial services sector, we face a higher burden than other sectors with our treatment under trade agreements, because there is something in trade agreements called the prudential exception, whereby countries have the ability to take an exception to a trade rule if there is a sound prudential reason. And this, hasn't been hasn't been litigated significantly. There have been a couple of cases where this came up in terms of, what is the scope of this prudential exception to get a regulator to say we're not complying with anything because we think this is important for prudential reasons. There is a need to prove that taking the exception for prudential reasons, that you have to have some reason, whether it's protecting investors or depositors in the country. But it's, the key point is that this is another hurdle that we face within our financial services sector, within trade agreements.
So probably one issue that we've heard a lot about today, maybe consistently, has been China, pretty much in every session, and for a number of reasons. It's in the news. There are discussions going on. So let me just, I'll throw this back to Yancy if he can comment on just his views on the U.S.-China negotiations.
Hopefully no press in the room. Checking any latest tweets. So my CEO, Evan Greenberg, is the current chair of the U.S.-China Business Council, and I support him in that role. And just so you know, the U.S.-China Business Council is a group of American companies that have operations in China, so a vested stake in the country. So I'll just start by saying, the U.S. Under the administration, under USTR, has really, we agree, I think the membership of the council has identified the problems that U.S. industry faces in China. I think everybody's heard these by now, forced technology transfer, concerns with theft of intellectual property protection, the role of state-owned enterprises in the market, subsidies that distort the market. So these are all issues that are on the negotiating table. I think the tweet from today, it just signifies, we're at a point where we're sort of in the last mile of these trade negotiations. And I think all the trade negotiators at the table would tell you the last mile is always the most difficult, the most contentious. I think part of the issue is both sides think they have the stronger hand, which makes these negotiations difficult. What the U.S.-China Business Council hopes for and has been advocating for is constructive engagement between the two parties. I don't know if folks in the room saw the exchange when the Chinese were in the White House, and there was a debate between the president and his trade negotiator over what exactly this is. Is it an MOU or an agreement, or whatever it is? We hope that it will address some of these structural issues that I noted. But we think it's important that we end up with something that is practical and results-oriented. Again, something that we can monitor and something that is enforceable. None of that is an easy task. But, I do want to touch on the point that, China is a very important market. This is a little bit different from, the trade frictions we had with Japan in the early 80s, because Japan has never been the size in terms of its own consumer market that China is today. And, there was a saying, China is a country of promise, and it always will be. But I think that really has changed. And I mentioned I was in the auto industry. When I was in China in the early 2000s, there were annual sales of new cars was about 7 million units. and in the United States, it was about 16 million. Today, in the United States, it's about 16 million, and in China, it's about 27 million. Almost twice as many cars sold in China today than in the United States. So you talk to GM, who sells more cars in China than the US, they'll tell you that China is an important market. The insurance sector is a little bit further behind, but growing. So today, global insurance premiums in 2017 is about $5 trillion. In the United States is about 30% of that. So our insurance market is a little over $1.3 trillion. China and the insurance market, when I was there doing autos, basically didn't exist. I mean, we're talking hundreds of millions. But in the next 10 years, China will be larger than the United States in terms of premiums. So the question isn't whether China is going to be a big market. It already is a big market. The question is whether foreign participants will be able to capture some of that market. But even if you capture a small share, you know, the material impact will be significant. So I think I'll stop there, because I'm sure it seems like all the questions have been about China. So Q&A.
Thank you, Yancy, for that perspective. And it is a good point. China does get a lot of attention, a lot of media attention, but there are other trade initiatives out there that are really important. And one of them is the US-Mexico-Canada agreement, or USMCA. And I would turn to Christy and just ask her, how would she assess the USMCA? And also, where does USMCA build on the successes of NAFTA for financial services?
Thank you, Paul. I think when we talk about USMCA, it's always important to step back and look at the NAFTA framework and really what's happened over the last 2 decades, which is pretty remarkable, and particularly for the U.S. services sector in terms of how well it's done in the North American market. Because for that last period, 2-decade period of time, the services sector has consistently produced a U.S. trade surplus with Canada and Mexico. And as a result, in 2016, U.S. services exports alone were supporting about 580,000 U.S. jobs directly. So there's a very positive story that we always begin with in terms of NAFTA. And again, back to Yancy's point in particular, in looking at this picture, it's not just the services exports, but it's also the considerable foreign direct investment that was enabled particularly in the Mexican market, certainly in the financial services sector, very significant. And also the reform of the state-owned entities in Mexico, which was in large part captured under the original NAFTA agreement and followed on to once it was implemented. So what you have today is a very significant number of U.S. jobs being supported by NAFTA. And then the other thing I would say is that NAFTA preceded the negotiation of the General Agreement on Trade and Services in the WTO. So it's important not only for the very concrete trade benefits that it's produced and the framework that it's established, but it also helped to set a floor for commitments for services, even before they were negotiated multilaterally. So it serves a very important precedential value. So in terms of that, USMCA definitely builds on that NAFTA structure. And for financial services, I think the highlights and the major achievements that were achieved in the USMCA is one, we've been mentioning this first ever data localization prohibition that Kimberley described, which was a major achievement, which the US government initially attempted in the TPP, wasn't able to get accomplished there. But it was very significantly in USMCA, and so that's a critically important provision. Secondly, the expansion of protections for cross-border services, including electronic payment services. And again, a very important step forward. And as I said, it's becoming an increasingly important service within the financial services sector, so it's very important. There were also some additional investment provisions that were added for national treatment and MFN for financial services, even though there were carve-backs with respect to individual investor protections, which we don't want to see happen in the future agreement, but nonetheless, all of those were positive elements with respect to financial services. Also important for financial services in a general sense was the digital trade chapter. And there for you, what you see is a world-class set of standards with respect to cross-border data flows, data localization, prohibitions on transfer of technology, source code, algorithms, cybersecurity provisions, non-discriminatory treatment of digital products. So a treasure trove of critically important elements in that regard. So just highlighting the financial services side of the picture, I would say considerable building on the success of NAFTA and also the digital trade provisions. And so we certainly at CSI are very supportive in seeing the agreement move forward and be passed by the Congress.
Thank you, Christy. Obviously, the UK is very important for financial services, and just wanted, and we heard from Philip Kenworthy from the British Embassy earlier today, who had some really informative comments. I thought we'd just take a minute and to ask all the panelists, how is Brexit either impacting their company or their members? And we've got about 7 minutes, so just we'll ask everyone to be somewhat brief.
Thanks. I think we probably can, because we might have a very common story to tell. For AIG's perspective, we took a decision pretty early on to hedge our bets and establish a second basic headquarters on mainland Europe in Luxembourg, which is known for its the quality of its insurance regulation. That involved a lot of work, frankly. I mean, because we had to, in addition to setting up an office, we had to adapt all of the insurance contracts that were written based upon presence in the UK and the UK regulatory system to Luxembourg, which was a massive conversion project. We just, I think, concluded that in the last 6 months or so. So for now, we're kind of stable and just looking at whatever regulatory adaptations may be necessary depending on the outcome that emerges from the whole process. So we do, on the whole, want to see an outcome, a positive outcome and a stable outcome as quickly as possible.
2 sentences, because it is very similar. So I would just say the financial services industry is probably further ahead than almost anybody else in terms of being prepared for Brexit. It's such an important issue for us, and many of us were based in London, so we moved our sub to Paris as of January. So, you know, the contract sanctity issue is one that we closely work through.
Sure, and I think one of the reasons that the financial services industry is so well prepared is that because regulators are responsible for financial stability, Bank of England and European bank regulators wanted to know, what are your plans if there's a hard Brexit? So being forced to come up with what that plan would be, and our own interest in ensuring continuity for clients to be able to serve them, companies had to go ahead and make some of those adjustments. We had the plans over a year ago of what we needed to do. So at Citi, for example, we established a new branch in Germany, and we successfully converted a Frankfurt-based subsidiary into an investment firm. And these are 2 key milestones in our planning process in order to have that continuity of service going forward.
Thank you, Kimberly. So we heard a little bit this morning about the World Trade Organization. And, you know, before we do wrap up and open up for a couple questions, I did want to throw a question to Chris about, you know, how does the World Trade Organization, WTO, factor into all of these discussions? And sort of where are we regarding the WTO?
Well, this one was thrown to me in part because AIG hosted a conference last month on where is the world trading system going, and so I learned a lot about that, and it's actually part of a three-part series that we're sponsoring. First meeting was in Washington, the second is in Rotterdam in a couple of weeks, and the third is in Shanghai, where we're looking at all of the challenges confronting the global trading system and bringing together think tanks, experts, and practitioners, and trying to produce some actual recommendations going forward. I think there are, one area of near-term, very trade wonky concern is what's happening with the WTO dispute settlement system. And what's happening is the U.S. administration is effectively blocking the selection of panelists for what's called the appellate body, which is, in the WTO system, you have a dispute, you go to a panel, the panel makes a decision. If the respondent doesn't agree with it or finds some fault in it, it has the right to appeal. And so it's the appeals body that is under question at the moment. By the end of this year, there won't be enough judges or panelists to hear any appeals. So that means that any WTO dispute that moves to the appeals process cannot end because the parties have the right to appeal. What does that mean? If the dispute settlement system cannot function, then countries are left on their own to try to resolve their issues, their problems. And that leads to instability, leads to trade conflicts, potential retaliation, no brakes on the retaliation, and the potential for escalating trade wars. So this is a hidden issue. It's one of great concern. The U.S. is not just being crazy. They do have their ostensible reason, well, their reasoning is that the appellate body in the past has taken expansionist interpretations of the WTO obligations. And so they've effectively interpreted the WTO commitments in a way that the U.S. and some others does not agree with. And so that the view is that that's really creating new law and changing the nature of a sovereign commitment. There are, so you've got this problem that there are, that is not only held by the United States. How do you solve it? At our conference, we did have a number of experts in the room that put forward some proposals on concrete reforms. Canada has organized a group of WTO members that's also working on reform proposals. But this needs to happen over the next 6 months, and so it's something that we're looking at closely and hoping to encourage a solution in the near term.
Thank you, Chris. And let me just one related question to the WTO that I'll throw to Kimberley. Given the challenges of reaching agreement in a member-based or member-driven, consensus-based organization, do you want to share any thoughts on what might be a way forward?
Sure. Well, I mean, as you're aware, there haven't been new services commitments in the WTO, at least in financial services, since 1997. And obviously, the world has moved on and forward. And in this globalized world, how do we get new commitments in services, especially in an organization where other members have other interests, such as agriculture or in the goods area, and they take hostage any commitments or new ideas that might be percolating in the services space. So, one way forward, and we've seen this in one agreement in the WTO, is to have a plurilateral agreement, an agreement where it's optional to sign up and take on the commitments in that agreement. And we saw this play out in the government procurement agreement, where still today, countries are signing up to those obligations to allow providers from one country to bid on procurement contracts in another market. So as you may or may not be aware, because of the progressive ideas in the digital area and the effect that all of these issues have in the services area, one proposal had been to work on rules very much that would look like the rules concluded in TPP or USMCA in digital trade. And as we all know as trade negotiators, these things can take a very long time to negotiate. So in Buenos Aires in December 2017, there was a joint statement that was issued by the members to begin to think about what the aspects of an e-commerce or digital trade agreement might look like. And it's not surprising that Australia, Japan, and Singapore, 3 members of TPP, who, with the United States at that point, had been pushing these issues in that agreement, were the co-conveners of this work. And that group, 117 countries actually, met 9 times during 2018. And most recently in January at Davos, 76 members of the WTO confirmed their intention to launch negotiations on an e-commerce agreement, which would include things like free flow of data, and data localization, electronic payment services, e-signatures, all of these types of issues that, frankly, we as services companies want to see pursued. So the negotiations have been set up such that they're going to take groupings of different issues. Meetings have been planned for May, June, and July of these 76 members made up of developed and developing countries. And negotiators made their first proposals by last Friday. It's not, it's not a deadline that no other proposals can be made, but some countries made proposals and some published them online and others did not. So for example, the EU published their views on these issues online of what they would like to see in this agreement with real concrete textual proposals. So we think this is a good way forward. So not to get caught up in having we must negotiate everything in the WTO in order to have something, but rather to focus on where can countries agree with each other, and let's make progress in that area so that the WTO can take on that new life that it needs to take to go along with the reforms that Chris is talking about, but also to address new and emerging issues in services trade.
Wow, well, let me first thank the panelists for really outstanding content this afternoon. Thanks, everyone. Can we take 1 or 2 questions, George? Or
Perhaps one.
all right, let's do 1 question.
Hi, thank you very much for all of your comments, very useful. My name is Rhea Thomas, I'm from Wilmington Trust. I just had a question. Many of you have experience with negotiations or in China, and I was curious from your personal perspective what you think this weekend's developments on the China kind of trade front mean for whether a deal will get done. And from the services perspective, so far, from a broad macro perspective, the economy has held up, at least in the US, relatively well relative to the manufacturing sector. If you look at the ISM manufacturing or the jobs report, you saw strength on a relative basis in the service sector. And if a deal does not get done, are you worried at all that we'll start to see broader kind of economics slowing and impacting the services sector as well?
Well, thank you for the question, and I know Yancy's already addressed this to some degree and likely to have other comments. But from the perspective of the Coalition of Services Industry members, I think, as Yancy said, it looks like this could be toward the end of the negotiation where it's not uncommon at all to see both sides kind of play, high-stakes poker with one another. So I guess our hope would be this latest series of tweets, that's what it is. It's to try and push to get to the end of negotiation. What we continue to look for is a commercially meaningful agreement that's enforceable and can be monitored, as Yancy said. From the services perspective, we're looking very closely at both what's in that package We've heard a lot in the financial services areas over the last couple of years, 2 to 3 years, about things that China was promising to do, including in the insurance sector. So we want definitely to see those go forward, be nailed down. Electronic payment services, another one where we definitely need to see some more licenses issued. But we also are interested in long-term reform, so we'll see whether that's part of the package. To your question about what does this all mean, we don't think that tariffs are ultimately the answer. So we have been watching very closely on the tariff front the administration's use of that tool. And it is something that is of concern to the services industry, both directly and indirectly. So our hope would be that that will drop to the background, and the focus will be on a pragmatic, solid framework with real results that is enforceable. But I don't know if that helps, but from a services perspective, tariffs are not just benign. It is something we look at too.
Okay, we're going to wrap it up there. Thanks again.
Thank you. 5 minutes. All right. Thanks for me also for this distinguished panel and the very interesting conversation. We are at the end. Now George has told me that I have only 5 minutes. I was planning to have another 20 minutes, but anyway, he's the boss. Now, what did I get as a few takeaways from today's conference? And also, I am going to be also giving you the opportunity of having one more question at the end. I don't want to disappoint you. Now, first thing, and I was trying to get the sense from the discussions in the different sessions, and in all sessions we are getting, I think, a similar kind of a message, that trade tensions and protectionist policies lead to global trade reduction, global uncertainty and loss of confidence, which is a major ingredient for loss of investment. And this environment leads to global recessions and also a reduction of economic activity. Now, a second takeaway was that promotion of open and fair trade and cooperation on trade agreements, arrangements, we had it in different ways being expressed, are essential for maintaining the positive sentiment among consumers, businesses, and investors, and in turn, I would say is important for strengthening the global economic and financial stability. The third takeaway is that the recent trade developments and the trade agreements should aim to strengthen the multilateral trading system, and in this way to help support the global growth and I would add productivity. And the other takeaway from me, the last one, that it came from President Hacker's comments, is an important one, I think, is that the Fed's quantitative easing normalization could take another 10 years. So this is for me a summary of what I heard today, and I abstracted from a number of very interesting presentations and also comments that they came and answers to the comments. And as I promised you earlier, I'm giving you the opportunity for one last question before we wrap it up.
Of course.
No questions. All right, very successful. Thank you all. Thanks very much all the panelists. Thank you all for participating and looking forward to see you in a future event, GIC Drexel event. George?
I want to mention, thank you, Michael, appreciate it. And I want to mention the material will be placed on GIC's website sometime within a couple of days or so. Thank you very much for attending and appreciate for you coming, especially those from out of Philadelphia, outside of Philadelphia.